Over the last 20 years, the US dollar's share of global foreign exchange reserves has quietly dropped from over 70% to right under 59%. And if you follow international economics, you already know that is not just some rounding error. It is a massive signal. Welcome to this explainer on the Yuan Challenge. We're going to break down the deliberate structural redesign of global finance and look at exactly how this multi-decade shift is actually accelerating right now. Let's get right into it.
For nearly a century, the US dollar has essentially been the undisputed heavyweight champion of the world, right? I mean, it is the absolute bedrock of global trade. But today, that vibrant green is, well, it's starting to look a little pale in certain corners of the globe. And guys, this isn't just about swapping out currencies, it's about a fundamental, ground-up shift in global geopolitical leverage.
Section 1. The dollar's global reign.
Think back to right after World War II. The dollar didn't just become the global reserve currency, it essentially became the mandatory toll booth for the entire world's economy. For decades, if a nation wanted to, say, move a barrel of oil across the ocean, load up a massive cargo ship, or trade physical gold bars, those transactions almost exclusively flowed right through the US dollar. That absolute, unchecked hegemony granted the United States an unprecedented level of economic control, privilege, and, of course, stability.
Section 2. The wake-up call.
So what changed? Well, the unprecedented severing of major economies from the SWIFT messaging system really sent shockwaves through non-Western capitals. When targeted nations suddenly went completely dark due to sanctions, it was an absolute revelation for countries watching from the sidelines. And look, regardless of the politics behind those sanctions, we're just looking at the financial mechanics here. Capitals all over the world realized something terrifying. Relying 100% on a US-influenced financial system is a massive strategic vulnerability. Basically, one severed connection in your entire economy is paralyzed.
Section 3. A quiet financial plan.
That massive vulnerability prompted a very deliberate, strategic workaround, and it all centers around the petro-yuan. Now, what is that exactly? It's the pricing and settling of international crude oil trades in Chinese yuan rather than US dollars. Think about it. For half a century, the global oil trade's total reliance on dollars created this constant built-in demand for US currency. But with the launch of yuan-denominated oil futures contracts in Shanghai, we're seeing the actual plumbing being laid down to bypass that legacy system. It isn't just a simple currency swap. No, it is a direct attempt to rewrite the rules of global commodities.
And this strategy, it isn't just a single attack. It's a multi-pronged financial architecture. First, it starts with building a foundation of deep trust by aggressively hoarding physical gold in domestic vaults. Once you have that bedrock of stability in place, these nations are completely bypassing the dollar by securing bilateral trade agreements that are settled directly in their own local currencies. And finally, the big one, they are redirecting the literal lifeblood of the global economy by shifting energy pipelines to settle in yuan. So it's this slow, incredibly calculated motion, all designed to structurally insulate their economies from Western oversight.
Section 4. The BRICS alliance expands. Now, these individual trade maneuvers, they are actively being institutionalized right now, especially as the BRICS alliance absorbs massive energy-producing economies like the UAE and Saudi Arabia. This is no longer just some static club. It is a rapidly expanding geopolitical bloc that is actively testing parallel infrastructures. By developing alternative payment systems like China's SIPs and cross-border digital currency projects like mBridge, a decentralized financial network is quite literally being built from the ground up. The ultimate goal? Ensuring long-term economic sovereignty.
Section 5. What is at stake?
Let's bring this all back home and ask, why does this matter to you? Well, if the dollar is no longer the mandatory currency for global trade, that massive, built-in global demand for US currency drops. And that triggers a really dangerous domino effect. Because with less demand, foreign nations buy fewer US bonds. If they stop buying that debt, the cost of borrowing for the US government absolutely skyrockets. That makes it incredibly difficult to fund global operations, from military bases to domestic infrastructure, and ultimately, it hits the everyday American right in the wallet through higher inflation and intensely volatile interest rates.
The unquestioned certainty of American financial invincibility is, quite frankly, dimming. Now, to be clear, this isn't necessarily an overnight collapse. It's more like a slow structural shift in global influence. The era where the American financial system perpetually and exclusively anchors the entire world is fading, and it's rapidly being replaced by a much more complex, highly competitive reality on the ground.
So as we look at a world that is increasingly split between a legacy dollar-based network and a rapidly emerging alternative, we really have to ask, which infrastructure will ultimately define the future of global trade?
Are we looking at a future where these systems just coexist in a permanently divided world, or will one eventually overtake the other? Make no mistake, this is the defining financial redesign of our era. Thank you so much for joining me for this explainer, and definitely keep your eyes on those shifting global pipelines.